Okay, so good evening, everyone. I'm Mark with Binary Options Bootcamp, and tonight presenting a very special webinar, Hedging Strategies Using Nadex Binary Options. This particular webinar, I was very excited to share this information with you because early on in my binary options trading, I was having a level of success, but I was not managing my trades well, much less my losing trades. And then when I discovered specific hedging strategies and how to incorporate that and kind of fine-tuned it as I went, it really allowed me to soar and stay profitable month to month. So it really kind of changed my trading game and how I go into a trade and how what I'm thinking, how I'm planning every single trade. I'm thinking about not only what happens if the trade goes right, but what happens if the trade goes wrong, because you should have a plan before you enter that trade. So we're going to discuss that shortly. So without further ado, let's go ahead and dive right in. All right, so what are we going to cover today? I'm going to briefly go over what hedging is. I mean, some of you may have an idea of what it is or have a good idea of what it is, but I'm going to just go over a brief definition of what that means. And we're going to talk about hedging objectives. What do we plan to achieve by hedging? I'm going to show some hedging examples. We're going to go over some strategies. And then we're going to talk about managing our trades. Once we've incorporated hedging into our trade plan, how do we manage those trades? And then I'm going to open it up at the end for a little Q&A. So feel free. Are we having audio issues? Can you guys hear me okay? Yes. Okay, excellent. All right, so, and then I'm going to open it up to Q&A at the end. So if you want to stay on at the end and ask a few questions, feel free. Be happy to field those for you. Okay, so what is hedging? By definition, as it relates to investing, hedging is simply taking one investment of a particular security and investing into another security or investment that have negative correlations. So what that means is as one goes up, is trending up, the other one is negatively correlated, so it will go down. So if you have a hedge fund manager, he is probably developing and managing your portfolio the same way. Obviously, if we have a bunch of securities in your 401k or in hedge fund, and they're all tied together and they all go up together and they all go down together, that's not really the best method. So we incorporate that into our binary options trading. So that's essentially what hedging is by definition. And then I also wanted to add just a little tidbit of information about the FIFO rule, which is the first in, first out rule. This applies specifically to Forex trading in the United States. As of 2009, they made hedging illegal in the United States as it applies to Forex trading. Not in binary options, but just traditional Forex trading. Now, there are ways to get around that. If you have two separate trading accounts, you could obviously trade in two different directions on the same currency pair, but just a little tidbit of information I just wanted to add. Without further ado, let's go ahead and advance. So what do we plan to achieve today with hedging? So first and foremost, what should be on the forefront of your mind is to preserve your capital at all costs, okay? This is why we're learning how to hedge and how to incorporate this strategy into our trade plan, is so we can preserve that capital, because either we want it to stay the same or get bigger. We don't want to go back, right? If we have a $1,000 account, we don't want to go to $9.99 or less. We want to either break even for the day or obviously grow your account. So using hedging strategies, you're going to be able to do that. So, and number two, and this is really, really important, we want to aim for a minimum of a 1-to-1 risk-reward ratio. I had trouble practicing saying that, but got it that time. Or better, so preferably a 2-to-1. So what does that mean? So in the binary options world, if you're thinking of an at-the-money trade, so if you're investing $50 in a binary options trade, you're going to get $50 reward if it expires in the money. So that is your 1-to-1 risk-reward ratio. Now for an example of what a 2-to-1 would look like, let's say we did an out-of-the-money trade at $25, say we're buying. So we bought a $25 trade, and we take profit when the value of that trade hits $75. So we invested 25, our reward was 50. So we made 2 times our investment, or a 2-to-1 risk-reward ratio. Okay. Also, this is going to help you create a plan before every single trade. We don't want to just go willy-nilly into a trade. We want to think about multiple scenarios and what we're going to do. So if it does A, what am I going to do? If it does B, what am I going to do? If it does C, so that way you have it all covered. You know exactly what you're going to do. And when using hedging, it really allows you to stay calm and just use math and probability to win. And in the case, so let's say you break even or have a loss, keep your losses small because you're reducing your loss by using hedging strategies. So, any questions so far? No? All right. Let's continue on. All right, so here's 3 solid examples for hedging. So either one, and I use this a fair amount, hedging with the same instrument. And I'm going to show these examples on a chart, but I just wanted to explain them briefly. So hedging with the same instrument, so basically if you were, we all love the Wall Street 30, so if you had basically used 2 trades going in opposite directions on the same financial instrument. Example 2, hedging with an instrument that has a positive correlation. So if, let's say, again, I'll be showing these on the chart, but if we have 2 financial instruments that both go up together, both go down together, but you're trading in opposite directions on each of them. Example 3, hedging with an instrument that has a negative correlation. So where one instrument goes up, the other one would go down. So in that case, you would you could trade in the same direction. I'm sorry. Yeah, in the same direction. So without further ado, why don't we show an example of what those would look like. Give me just a second. Okay, so here is the Wall Street 30 for today, and I kind of, these red vertical lines represent the beginning and the end of the trading day today. So you can see we had, and let me get my laser pointer here. Okay, you see we clearly had an uptrend today. Okay, so at some point you wanted to enter with a trade during the day. So let's say you saw this downward spike, okay, and you said, oh, I think it's going to be a down day. So let's just draw a line that represents a trade entry. So let's say we got in about right here, and I am going to color it red to signify a sell trade. Okay. Can everybody see this red line here? I just want to make sure it's kind of, is that showing up on the screen okay? Okay, thanks, Pam. Okay, so obviously you were wrong and the market started going up. Okay, so in the example on where you can trade, and let's actually make this an actual, today they were even. Today they were even. So 580 would have actually been a strike, a daily strike that you could have chose. Actually, let's move it up because it, well, I guess it doesn't matter. All right, I'm going to move it up to 600. Now 580, sorry. 580 would have been close to at the money. Let's say you got it at the money on this little drop here. It's just an example anyway. Okay, so if you were hedging on the same instrument, okay, so you're like on this candle right here. Let me get my laser pointer back again. On this candle, you're like, oh crap, I was wrong. Okay, so what I usually do is on the daily strikes on the Wall Street 30, they are 20 points apart. Okay, so if I got this sell for at the money, then I basically want to have an insurance policy for, or I basically want to wash that one out. Okay, if I made a mistake, I want to wash this one out. Okay, so let me get my pointer back, and then I am going to buy the 600. All right, now when you're trading on the same instrument, it does leave what I refer to as a dead zone. That means between these two strikes, which represents a 20-point difference, if the market ended its day in between these two strikes, you lose both trades. So it's very important that you are spending the rest of the day managing your trades appropriately, and then so basically we had a nice uptrend here. Okay, so your buy pretty much at this point in the day where it hit this top, you have a couple decisions to make. Okay, because your buy trade is going to be profitable, but probably not profitable enough to, if you took profit right at that point, it's not going to be profitable enough to cover the full loss of your sell trade. But that's, so you could just simply reduce the loss of the sell trade and then proceed with another trade in the day in hopes for a profit, and kind of rinse and repeat that cycle again. Depending on how far in the day we are, I will leave these both on, because I know, especially with the Wall Street 30, it has a lot of volatility. So I'm kind of banking on that, and it'll open up opportunities for me to add on another trade. So basically, I'm looking for these to wash each other out, and then I'm looking for maybe a reversal, basically another entry point to throw on a third trade. So you have a couple decisions. Either you can take the profit and reduce the loss. Okay, so instead of a $50 loss, maybe you have a $12 loss. Okay, but then I look for other opportunities where the market has exhaustion. So it had an uptrend. Today it was a little crazy because we had some really great volatility, great movement there. So just as an example, but let's say I think 660 was a trade, or maybe the 680. So we could have sold the 680. And again, now we're just using math, right? So we're saying, okay, if these two were to wash each other out, and then this one, I take this one for the win. Now, if you had a working order, you could probably get it close to at the money, but maybe you only made $30, $35 on here. Not really going in line with the trade strategy, but you could always take the 660. But today it was a little crazy. It really depends on market conditions. So so we're looking to basically wash out this trade or reduce a loss, and then throw on another trade to get us back in profit. Now again, the cycle can repeat if you're wrong. And then, so I'm going to leave that like that. So that, because I'm going to come back with other strategies you can use to basically get into another trade. So I just want to come back to that because otherwise it won't make sense. So that is hedging on the same instrument. But again, if you're following that rule set, it does leave a dead zone of 20 points. Okay? Now, here's just another strategy, say if it dipped and then exhausted and came up, you could almost reverse that. But I don't want to get into that right now. So we'll just keep it like that. So you have the dead zone, and I'm going to talk a little later on how you eliminate these dead zones through, later in the day. So that is hedging on the same instrument. Now let's talk about, let's say you got into, I'm just going to delete some of these. Okay, same scenario. You got into this trade, and it was going to, or let's say, just to make it fair, let's say it was going up. You saw it get exhausted around this consolidation range. You thought, based on your analysis, that this thing was going down. So you actually sold it, let's say 620 or 600. That's a pretty good one. So you would have gotten an actual good price because you're like, ooh, I'm going to get in early. I'm gonna get a good price for that. It's out of the money right now, and I'm expecting this thing to go down. Well, it didn't. It kept going up. So instead of doing the hedging with the same instrument, you could hedge with a similar instrument. So if we're talking a similar instrument, we would look at the US 500 or the ES. Because if we look at these, this is the same time frame, 5 minutes, and here's the beginning of the day, the end of the day. Now let's look at kind of the movement here, and then the movement on the Wall Street 30. Very, very similar. Very similar. So what you could do, if we got in at 600 here, obviously, you're going to know where price is at. So say it starts to go up a little bit, you could always buy on the US 500, and you could set it up where you don't have a dead zone. You could actually have it so it's very in tune to, very in line with where your trade was on the Wall Street 30. So let's say we bought there. I didn't memorize the strikes for today on the US 500, but so now we have a buy position here, and we have a sell position on the Wall Street 30. So this is hedging with similar instruments that are moving in the same direction, except you took trades in opposite directions. Whoops. So you bought here, and you sold here. Any questions? Does everybody understand that concept and why you would do that? And then all you're trying to do is reduce the loss. Remember, if you made a mistake, you picked the wrong direction, it's going to happen. What we're trying to do with this strategy is to reduce that loss and then move on to another trade where you're going to be right. Okay, any questions about that while we're in there? About that hedging with same or similar instruments? Okay, so now let's talk about, okay, we got into this trade. We thought it was going to go down on the Wall Street 30. We all know it didn't. It went up. Okay, so then, well, that's showing some dollar strength. Okay, so then we could start looking, if we wanted to hedge a position on an instrument that was negatively correlated, there's quite a few choices actually. So I have one here. Here's the pound dollar. It's not exact, but obviously it went down in the morning, and then it consolidated pretty much throughout the day. But as far as that, as the Wall Street 30 went up and this one went down. So if you sold, so if you're hedging with negatively correlated instruments, your trades would be in the same direction. So you sold on the Wall Street 30 and you were wrong. But if you sold on this pound dollar trade, you would be right. So let's say, I don't know, about right there, and then we'll color it red. Oops. One more try. There we go. All right, so this went down and it would have expired in the money, as you can see. Okay, another great trade would have been basically markets that are work adversely would be gold. So here is gold throughout today's trading, and obviously it had a downtrend. Now it did come back up. Like I said, they're not going to be, they're not going to go, candle to candle exactly the same or exactly opposite of each other. But it gives us some opportunities to hedge some trades. So, and to diversify your trades throughout the day, which is also good practice. Okay. So let's just say we sold around here early in the day after we discovered that our first trade was wrong. So again, and then we see market exhaustion down here, and we could take a trade with a buy. Okay, and then we diversify that. So as we see market exhaustion on all of our financial instruments, then pound dollar. Oops. So now you're creating an iron butterfly on basically each financial instrument. So, and for those of you who don't know what an iron butterfly is, basically it's a sell trade above a buy trade, and if price finishes in the middle, you win both. Okay. But again, so the point is hedging using a financial instrument that is negatively correlated to the one that you're trading on. So if you have any questions about what markets might qualify, or hey, I trade these 2 or 3 markets, what would be markets that would be negatively correlated or positively correlated? So ones that are going to move up together or ones that are going to move in opposite directions. Okay, any questions on trading two instruments that are negatively correlated. Anything at all? No, no questions for Brian. Okay. Did you see? Hold on, I think we might have a question. There we go. All right. Sorry, I'm just looking at a few questions here, guys. Can you repeat the instrument you would have sold along with the pound dollar? Basically, I'm comparing it. If we talk about the Wall Street 30 or the Dow E-mini. So that's typically the market we're always talking about, SG. So basically, I'm comparing all of these to the Wall Street 30. Does that answer your question? Okay, great. All right, so let's go back to where I was here. All right, so those are examples of how you could hedge your trades. All right. So here's a couple strategies. I kind of started talking about them in there. So a three-leg trade. So using structure levels. I know Brian, he keeps repeating about using levels. So I was planning to discuss. So we want to make sure that we're paying attention to structure levels, value area, deviation, anything that's going to hold a level of importance, especially when it comes to hedging your trades, because that's going to give you an indication of how far a trend may go and give you an indication of when you should probably take profit. Because, so I'll explain kind of some of the strategies I use when I'm using a three-leg trade, which is typical. That's pretty much the one I try to use if I'm wrong. So I'm also going to talk about changing dead zones, which I explained. If you're hedging on the same instrument, changing those to iron butterflies, which I just explained. So iron butterflies, if price finishes between those two lines, you win both. If you have a dead zone and price finishes between those two lines, you lose both. So we don't want to be in that scenario, well, the whole day. So we try to use some strategies to change that. And speaking to which, I incorporate intraday trades typically later in the day to kind of close those gaps. So I'm going to discuss that. And let's see. Yep. Okay, so let's talk about that real quick. So let's go back to the chart. All right, so kind of what I was talking about here. So let me go back to the 30. Here we go. All right, so we have our trade that we are obviously wrong about. So we're going to throw on, if we're hedging with the same instrument, then we're going to end up creating a dead zone. Okay, I want that to be a temporary situation. Okay, so now anything that if price happens, if I just let the market go, but price came between these levels at the end of the day, I lose both trades. I don't want that. So I'm going to look at the market, look at the market conditions. I'm going to leverage the structure and support levels, that being way of value area, that being way of deviation levels, pivot points. I don't want to get overly complicated, but obviously I post the value area and the deviation levels every single day. Well, for the most part. So those are the areas you want to look at, okay? Just because we're hedging a trade doesn't mean it's a set and forget, okay? Because if you're looking for that, you know, I could sell you some snake oil, because there ain't one. All right. So in this particular case, we put in our insurance policy, our hedge trade at level 20,620. The market made its way up into 670s range, almost 680. Okay? That's not a huge margin of safety. Okay? So just pretend let me get my rectangle tool back. Okay? So say this didn't even occur yet. We just see this uptrend. Okay? We're thinking, okay, all right, my buy trade's in profit. Okay? And you want to think, okay, am I waiting till market exhaustion and I'm going to try to sell that? Okay, but if the market's coming back down at me, it's going to threaten my buy trade that is already profitable. So you want to start doing the math in your head. Okay, if you have $34 of profit staring you in the face, that's covering a potential $50 loss. And you know you're seeing indications. Let me get my highlighter. You're seeing indications, let's say, okay, we're looking around this area. So we're seeing indications that this thing is overbought, momentum's changing, it's going down, and our Fisher transform is this thing's way outside of Keltner, okay? We're like, this could be the height of the profit for this trade. So if I take my $34 and run, but before I hightail it out of there, sorry, let me go back to there. Oh, let me erase those drawings real quick. Okay. Before I hightail it out of there, I am going to wait for an opportunity using my trade criteria, and I'm going to sell the market. So let me change the color. And hence, we have a three-leg trade. Okay? So now, you don't want to take profit on your buy until you have validation that this one is going to bring you profit, right? So we want to make sure that our trade criteria is met. Okay, you see I have the trend counter trend line here. Remember from the previous training for those of you that attended. So it broke the counter trend line and it's going down. Okay, so that's an indication along with all my indicators that the market's going down. So that would be a good sell opportunity. Okay, so this one I have a certain level of confidence in. So that would be probably a good idea or a good opportunity to take profit on your buy. So let's take that $34, okay? Let me use my text note here. So I'm going to say plus 34, roughly, okay? It could be 30. All right. Yeah, so let me... There we go. So we took profit and we got $34, which reduces the loss of this stinker down here. But what is the market about to do? It's about to go back down, thereby reducing the amount of loss on your sell trade. So let's say this one expires, and let's say you got a close, you had opportunities to get this at the money. So I'm just going to say you got it at the money. So let's duplicate that. Okay. and we'll say 48. Say you got it, or you sold it at 48. That's fine. All right, so there's your profit there. And let's say when this thing hits a bottom or close, it reduced this. Let's just go conservative. So say instead of losing 50, you lose 35. That's fine. We'll just go conservative. All right, so doing some quick math, you made $47. So, and that's per contract. So this is a 3-leg trade. This is one I do pretty much I shouldn't say every day, because hopefully I'm not wrong every day with my first trade. But if I was wrong, this would be the first method I would be looking to do. So I would be waiting, I would put on my hedge, look for market exhaustion, and then I would take profit at the height. Soon as I saw every indication's telling me this thing's going to turn around, I would sell the market, take profit. Once I see, we have counter trend line breaks, okay, this thing's going down. I'm going to take profit on my insurance policy because it's there for a reason, guys. Okay, if this thing pulls back and goes back up and you took profit on your insurance policy, it's not the end of the world, but then obviously you're going to go with a full loss on your first trade. So this math would be slightly different. Okay, so that's a 3-leg trade. Any questions there? Now again, you want to validate when that market is exhausted. Okay. Now I know Brian, he likes to do the OTMs, and it's been great him sharing that information with us. So you could also try to aim for those $25 to $35 price points, like if you're talking on a buy. So that way, and then we can kind of hedge doing that. Now, the strategy is slightly different, but it's pretty much the structure of the strategy is the same. So what are the 3 legs? It just means I put on 3 trades. So if I was wrong on the first one, I'm putting on a second trade to hedge it, and then I'm putting on a third to get profit, right? So the second one is only there to reduce loss or create a wash. Okay, so that's a 3-leg trade using hedging. All right. So changing dead zones to iron butterflies. This is, I kind of salivate for these opportunities because I like to maximize my profit, right? Getting the $47 per contract, not bad, especially after making the wrong trade, right? After being wrong, I still made 47 bucks. So I kind of like that. But I like to think of creative ways. Now this, I recommend the managing of hedge trades is something you definitely need to practice and demo. You need to get the timing down, because like any trading video that you're going to watch, it's all in hindsight, right? They're showing you how to draw this. They're showing you how to, oh, this trade went up just like I predicted. Everything's in hindsight. So I'm showing you this in hindsight, but you need to practice it over and over and over. And then when you are profitable in demo, then take that strategy to live. So as with any strategy, you should always be testing it out. And I don't mean for a day or two. Test it out for a few weeks. Make sure that you are knocking it out of the park. Every day, either you're reducing that loss after you were wrong, or, I mean, first and foremost, you should be using your analysis to be right the first time and take profit and be profitable. But if you're wrong, you should incorporate the strategy, manage it appropriately, and still come out ahead. Okay? All right, so changing dead zones to iron butterflies, and using these last two kind of go together. Using intradays to close the gap. So these are something I would do if the market had a lot of volatility today. It had a lot of trend. If that wasn't the case, then if you're getting a lot of ranging, then you're going to get a lot of confusion because you're going to be like, oh gosh, it's just floating around. So let's talk about that, because it can be, again, once you get used to it, you're going to be calm about it. You're going to have patience, and you're going to look for opportunities. And using these second strategy 2 and 3 is going to help you, because you definitely don't want, if it's ranging, you don't want a bunch of dead zones, because it's going to open you up for increased loss. So, okay. All right, so let me erase this. All right, so how can I replicate this? Okay, say you got into the trade. I think I'm going to move it over. Okay, see all this consolidation here, basically from the end of the day today to now. Okay, pretend we don't have many of these days on the Dow or Wall Street 30, but there are some. So you may have the high and low of the day may only be 40 points apart. And when you got daily strikes that are 20 points apart, hedging can be difficult. So what you want to do, and there are days where you just pull the rabbit out of the hat. You're basically just waiting. You're using your analysis to find opportunities to get profit. So how can I add a third leg to my trade if this thing is barely moving? So it's barely going up, it's barely going down. So it's hard to kind of draw this on, because this is just flatlining. And you'll see some level of volatility, like 25 to 50 points. That's kind of a low day on the 30. So what I would do is, let's say, again, let's just kind of move this over. So let's say I'm going to draw a rectangle over the things I don't really want you to pay attention to. All this volatility, just don't even look at it. Okay, everything to the right of this big square, that's what we're talking about. All right. So let's say we saw this candle and we're like, oh, we're going down again. So I'm going to, let's say it's odds day. So I sold the 630. Right now, the price line is right over it, so it's hard to see. But it's a red line under this light blue line. And I'm going to move this down here for now. And then the market goes up, right? So let me kind of expand that. There we go, that's better. So we sold the market right here because of this candle. We're like, ooh, it's going down, okay? Then we got this doji star and it started going up. So what do? We hedged. So as soon as it got 20 points above that, which would be the 50, and now look what happened. Well, Mark, you told me to get the next strike, and the market just went right back, and it touched my other strike. So pretend this is actually a good example. Pretend this is happening right now, like it is. It's like, well, now I have this huge dead zone. Well, it's not huge; it's the same size as, the previous example. I expanded the screen, so now we got this big dead zone, and the market's just playing inside of it. So I'm going to lose both, which is not ideal. So what do I do? Okay, Well, let me tell you, because it's happened to me several times. So what I would do is wait for later in the day when the 2 to 4 intraday opens up. Okay, so the 2 p.m. to 4 p.m. intraday opens up. All right, obviously, if this market before then goes down, continues to go down, then you're fine, right? Because you sold this, right? You bought this for 50, sold this for 50, and it's going down. So everything's going according to plan for like a 3-leg trade. But in this example, we're just saying it's ranging. So by ranging, I mean it's staying within that dead zone. And you're like, great, now I'm going to lose $100 instead of, breaking even or making money. So, what you can, let me change the cursor tool. All right, so what I normally do is I'll change this dead zone to an iron butterfly. Now you're still going to have the dead zone between these two daily strikes. But let's say one of the 2 to 4 p.m. strikes, especially in this example, let's say the market was turning around here. See how it's kind of getting exhausted, and you think it's going to go up. You're like, well, I don't know if it's going to break 650, but I need some profit. So you would grab a 2 to 4 intraday, and let's say you would buy, what I would normally do is, let's say there's a 627 intraday strike. So we have a little candle wick that touched it. So if we know it's probably going to turn around, I would buy under my sell strike. Because what does that do? That creates a little bitty iron butterfly. So if price finished within this little range here, it's actually 3-point range. Let me move this up a little bit. It's at 30. There we go. So now we have a 3-point butterfly. Not the greatest, but now this market is about to turn around, which reduces the value of my sell strike, right? But increases the value of my buy strike. Okay, so let's say, again, you got to plan scenarios in your head. What happens if this goes up? Okay, this one's going to be in profit. This one's going to be in a loss. Okay, so now if this thing obviously runs off to the races, I'm actually doing pretty well because I have 2 in the green and 1 in the red. Okay, so that's fine. So in that scenario, I'll probably have enough to cover this loss with profit. And once the market reaches a level of exhaustion, I would take profit here and then basically just keep these on and see if the market retraces some. If it retraces violently, I would just leave both trades on. If it just retraces a little and starts to consolidate and looks like it's going to turn around, I would basically reduce my loss on my losing trade, let this guy go to expiration, and that's a pretty good day. So that's how I incorporate intraday trades. I like the 2 to 4 expiration because they're only 15 minutes apart as far as expiration is concerned from the daily, which ends at 4:15, and obviously the 2 to 4 ends at 4. So I always try to use those if I have a close call. So it's like, man, I want to put a third trade on here. So how can I do that if I'm not getting a whole lot of movement? So, and then again, let me erase, and you could basically rinse and repeat this method by just taking, if you are getting good at taking profit. So let's say scenario 2, it does go up This is in profit. This is the loss on this is getting larger. But let's say this is value area, right? This is value area for tomorrow. What do we always look for? Maybe it's going to bounce off of value area high. So at that point, I would look for market exhaustion. I would use my trade criteria to see if I have a sell opportunity here. Okay? At this point, this is going to be close to a break even. All right? So I would basically do the same thing. I would look for a 2 to 4 intraday that is right above this guy and sell it, because then it creates a little butterfly. Okay? And then I would take profit on this one and let this come back down, and reducing the loss on my first initial trade. It's a lot of drawing and a lot of thinking, but these are things that you have to be thinking about when your first trade went against you. How can I use my levels? So you see in that particular example, I said, value area high, pretty significant level. Okay, look at this. Tested that level earlier today. Got rejected. It broke out with the wick, got rejected. Did a full, I didn't even realize this until now, did a full value area play. Nobody pointed that out? Nope. Okay, so those wondering what value area is, 80% chance, and it just did it pre-market or post-market, depending what you're looking at. And then what's it trying to do now? You guys should be putting a trade in. That's not a recommendation. Just speaking out loud. But you could see how these levels are important. There's a reason why we post them and why we talk about them. Okay, I didn't post, these are deviations from today, so I didn't plot those yet. But you could see how they're important. So this thing, will it turn around? It might. It's giving me indications. Not completely there, but it's giving me some indications. But again, that's what you're using to get profitable, guys. Okay? It's okay to be wrong, but you have to have a plan if you are. All right. Any questions about using intraday trades to kind of help you in markets that aren't as volatile? Maybe they're just ranging. Man, we should be having trades on right now. This just bothers me. So anybody have questions about that? It's just using math, guys. Kind of in my example with kind of, just think about that. This should be popping up in your head. Okay, I get a plus 34 here, or here. I get a minus 48 here. Okay, I put a sell up here. It's coming down. I got rid of this junker. Okay, I'll take profit once this, because I know this is a key level. All right, so I got a plus, 38 here. It's all math, right? Once I add all these up, I want a plus, not a minus, right? I want to be in the green, not the red. So it's just using levels and making plays like that until you're satisfied. Okay. Any questions? I know I have 5 minutes left. I think I'm doing pretty well. I don't think no hour and a half webinar tonight, unless you guys have a lot of questions. All right, let me see where I was here. Okay, so again, using intraday, I just say close the gap. That's no formal term, but you guys understand. So we want to change those dead zones to iron butterflies. So if price happens to fall back in there, we get paid twice, which is awesome. That's why I kind of love setting myself up to do that. All right, managing your trades, just some key points, guys. All right, for one, using this strategy, it really allows you to stay calm, because now you have a plan, okay? You should be thinking about it. I'm trading, I'm going long because X, Y, and Z, all right? But if it goes against me, I am going to do, A, B, C, okay? If you're right off the bat, use those levels, right? If it's a value area, you went long, it went up to value area high, it's stalling out, take that profit, guys. Okay, if you're right, reward yourself by taking that money before they take it back from you. All right? And again, I don't know how many times I'm guilty of this. All right? It's not going to help you if you put your insurance policy up. So basically, you were wrong in the example that you thought it was going to go down. You were wrong. And then you put your buy trade in 20 points higher, right? The market's going up, and it starts to go up with some velocity. But your loss is only at negative 25. It's like, I'm going to be smart. I'm going to take that trade out. I'm going to kill that trade now with only a $25 loss. I'm going to let this winner sky up, and I'm going to get paid. What do you think is going to happen as soon as you kill the first trade that you were wrong on? If you think you're smarter than the market, what do you think is going to happen as soon as you take your hedge pair out? You're very right, Trina. It's happened to me several times. I thought I was smarter than everybody else. The trade went right back in the original direction, which I thought it was going to go. So, but I took out my insurance policy. So I took a $25 loss per contract. I got rid of that trade, and then I bought into a buy trade, and now that went against me. So now I got to take a $25 loss on that. So we don't want to be in that position. So let your insurance policy stay in place. It's very, very tempting to take it out. It's like, oh, I'm going to reduce my loss. There's a reason why this works, guys. I don't know how many times, and I've done it on a much larger scale, and it makes for a very bad day. That means I have to make up that loss that much more. So put yourself in a good position by, working toward that three-leg trade, removing those dead zones, like the next point here. Eliminate those dead zones by implementing intraday trades later in the day, if necessary. If your third leg goes in the profit, so you basically have two trades in profit, one trade at a loss, kill them all, and you're done for the day, right? With some green in your pocket. All right. Ranging markets. This is kind of the example of using intraday trades to go back and forth. You're playing kind of ping pong, right, or tennis between that range. So maybe it's in a 40-point range, and you're like, oh, I got this big dead zone. I'm going to lose both trades. No, you're not. Use intraday trades, kind of play that tennis, and keep taking profit. This thing's going to go up and down about 10 times today. Let me just keep putting intraday trades in, and I'll play that, cut out any losing trades, and take profit, and I'm done for the day. I'll wait for some volatility tomorrow. Okay? Also, this one's very important. We love the 30, the Wall Street 30, because we know its habits and its cycles. Obviously, we have big trending days, we got blah, blah, blah. We have some ranging days, but we know its habits. For the most part. So identifying and becoming accustomed to specific financial instruments and just really trading those because you're good at them, you understand them better, is so much better than looking for opportunities across 20 or 30 different markets. Okay? Last but certainly not least, guys, make sure you have implemented and you're practicing solid risk management. Okay? Don't go, oh, well, Mark showed me how to hedge, and man, I've been winning, and I'm averaging X amount of dollars a day. You know what? But I'm only usually leveraging maybe 10% of my account to do that. You know what? I'm going to go big today because I can't lose. Guys, just don't do it. Okay? Have a goal. So if you have $1,000 account and you're using one contract in the three-leg trades, that's fine. Then say, okay, when I get to 2,000, then I'll up that to 2 contracts. Okay, set goals for yourself. Don't just swing for the fences. because bad things happen. Okay? And look at that. Oh, 1 minute over. Darn it. But I started 1 minute late, so kind of worked out. All right, so any questions on just some key points about managing your trades? No? Well, I'm at the next segment, guys, here. Little Q&A, you have me. I'm standing up, I'm energized, I'm caffeinated, so feel free. And as I answer, then, the admins of our group, we, offering up this information, make sure that after you practice it and you have, and it's profitable for you, that you pay this forward in some way. So, will you have a webinar on using spreads this same way? I think I need to relight that flame. I did create I did have a spreads webinar, and it's posted on. There are some. I really want to redo it because there are some points that I would like to change on there. But I did go into hedging with spreads in that webinar, but I think, and I actually haven't been using spreads as much as I used to since I've been hedging. But the Wall Street 30 is a great market to use spreads on. And it's a good way to hedge your binary trades. So instead of using a binary and a binary, you could use a binary and a spread. So I would be happy to kind of have hopefully a shorter webinar on spreads sometime in the near future. But do you have any specific questions about spreads? Thanks for the compliment, Trina. I appreciate that. It's actually, I think it comes up on the first, my webinar comes up for the first page for Nadex training? Nadex training or Nadex spreads. I think it's like 5th or 6th one down on YouTube. But again, there's some key points that I would like to do over in that webinar. Just getting to understand them and not real comfortable with them yet. Yeah, it's definitely a great product of Nadex, and it gives you a lot of flexibility because the difference between binaries and spreads is binaries are all or nothing if you're letting it go to expiration, okay? Where the difference, so how many of you have lost your binary trade by 1 point or pip? Anybody out there? Yeah, just took it right from you at the last second. Trina, how did I guess? It's happened to me too, though. So yes, many times. Okay, so let's say let me switch to my chart. Okay, so let me clear all this garbage. Okay, let's say we sold right here. Okay, so this was the end, right? So we sold right there. Well, the end, just say it just finished. Did we... Ugh. Did we win or lose that trade? If we sold, red means sold. Here's the end. We lost, right? And not by much, like 1 or 2 points. Okay? If we had a spread, remember a spread operates in $1 per point, whether it's net, loss or profit. Okay? So if we bought into if we sold a spread, remember a spread is basically a box, right? So say the box was from here and your profit potential to go down there. All right, let me change the color. There it goes. All right, so there. So that was our profit potential, this whole box. Price finished 2 points above the box. In a spread, remember, a point is $1. So if price finished $2 above the ceiling of my spread, how much did I lose? Yes, exactly, SG. I lost $2. If that was an at the money binary and I put in $50, I lost 50 because I was greedy and I wanted to go to expiration and I didn't cut loss early enough. So that's why I love spreads. I need to really start using them more. I used to use them quite heavily and it actually did pretty well for me. But really, I'm just trying to incorporate or keep using my hedging strategies and really trying to reduce or trying to increase the risk to reward ratio. So that's why Brian, he'd be the first one to stand in line to tell you he hates in the money trades, because then you're putting up $80 to make 20. And every video you watch, it's like, oh, well, that's an 80% chance. Well, I've lost plenty of $80 trades. So 80% chance, 80% schmance. It didn't matter nothing because I didn't know how to trade. I didn't respect structure and structure support and resistance levels. I didn't know what value area was. I didn't know what deviation levels were. I said, oh, 80% chance. So I'm going to take that. And then I lose $80 or more than that if you're doing multiple contracts. So under normal circumstances in the financial realm, if you had a $25 or 25% return on your investment, that's pretty awesome. So if you're putting in $80 to get 20 back, under normal circumstances, that's really great. But if you're losing 7 or if you're losing 3 out of those 10 ITM trades, you're at a break. I think that's a break even, right? It's either 6 or 7. You got to do the math. So that means you have to be pretty much 80 or 90% right to basically do in the money all the time. But if I'm using a $25 to $50 price point, especially like a $25 price point, I could be wrong 7 out of 10 times and still make money. So it's understanding how can I leverage the knowledge, knowing that I know value area levels, I know what they mean, I know deviation levels. So and also, if I think in the last webinar I was talking about before you jump on for the day or before you start making trades, you should start doing your analysis. So go to a higher time frame, okay? And I know this is kind of crazy looking, but this thing, you can see how much this moves and saying, okay, the market has been in a downtrend over the past, month or so. So let's zoom in on that. Okay. Now we have a lot of touches here, so we want to start mapping out some larger time frame support and resistance lines, because those should be respected too. So then we start zooming in. So we start from the outside and we start looking in. So after I say, okay, well, this hit, this is a nice structure level here. So I want to respect that. All right, we had a lot of touches here. So this is a resistance level, or where's price at? Oh, price is above it. So this would be a support level. So I just want to start I want to map these out, so the price goes up or down. Hey, okay, well, I see these are larger floors and ceilings for maybe not just tomorrow, but maybe for the rest of the week, right? Because this is a 4-hour chart. So then I say, okay, I'm going to keep those lines in, and then I'm going to go down maybe to an hour and just kind of drill down and see what I should pay attention to. Okay, we have a low here. All right, so kind of know the range. So where's range high, where's range low? All right, then we just keep zooming in. 15-minute, great great day trader time frame. Okay, what did this thing do yesterday or the last few days? Okay, and then in another webinar, I would like to talk about Fibonacci levels and how those should be respected. And when you are using tools to identify levels and they're compounded by other tools, like if I draw out a Fibonacci level and certain levels of that Fibonacci line up with deviation levels or value area levels, it strengthens those levels. Does that make sense? So if you are one of those traders that use pivot points, and those pivot points happen to overlap with value area high or value area low or deviation levels, it adds strength to that structure, support, and resistance. So those are areas either you want to take profit, or those are areas you want to get into trades. Does that make sense? Exactly, it reinforces. So let's just for giggles, because I have value area mapped. I don't have deviation levels mapped yet, but so that's value area for tomorrow. Right now, price represented by this sky blue line. Even though we're not in there yet, because this represents midnight Eastern time, the start of value area. So once it gets in there, this could go above and then back in. We'll see. But what I was going to say, we know that value area high and value area low are strong levels. Okay, so we can add on pivot points, which is available on any charting platform, or you can get them off a website. They're very easy to calculate. All right, so we have pivot points and support and resistance. Now we have pivot point smack dab in the middle of value area, and then we have our first level of support pretty much at the bottom of value area. So those are things to look for. Okay, I don't have my deviation mapped out yet, but they might line up with some of these. And again, when compounded like that, and compounded with structure, resistance, and support from higher time frames, if you have 3 times, that really, you should really pay attention to those areas. So, and when using Fibonacci, that's when I start to see, oh my God, this is like a 90%. I'm going to take this trade. Everything's telling me that nothing's going to get past this level. And if I'm wrong, what am I going to do, guys? Come on, give it to me. What am I going to do if I'm wrong? Thank you, Trina. I'm going to hedge. So I have a plan if I'm wrong. Even if I think I have 90% accuracy on this trade, it could always go against me. Okay, Trump can always say something and screw it all up. So any questions, guys? Any other questions? Comments? Anything? Any suggestions for the next couple webinars? Do you put on a hedge for every trade? Trina, only the trade that goes against me. I'm hoping to be right the first time. Thank you, SG. Appreciate it. So you would only use a hedge if you are wrong on your first trade. If you're right, then you're using these levels to take profit. Just real quick. So let's say you knew, the market's going up. It was trading pre-market. It bounced off of value area low, starts creeping up, and you're getting higher highs and higher lows. So it's like, ooh, okay, well, I know this pivot point is here, so maybe I'll use that as a strike price. Whatever strike is closest, maybe I'll get under it, because then I got value area low, and I have S1, or support 1, as strength. So if I'm right, then we're all good. I don't need to hedge. But I'm looking for areas to get out of the trade. Unless this thing goes way up, and I'll let a trade run if we're looking at like a 100-point cushion. But I've seen the market retrace 100% after 100 points. So don't just walk away from the computer and go lollygag the rest of the day. So, but once this thing reaches value area high and starts to show levels of exhaustion by use of your indicators, then it's like, what do we do then? What should we be doing at that level? If we were right the first time, what should we be doing, guys? Take profit. Thank you. Get that money and then enjoy your weekend. That's what you should be doing. All right. Any other questions, guys? Did pretty well on time today. I hope that helps. I really want to hear. I really want to hear some feedback, please. You're welcome, Lyle. Guys, that's why we have the group. I really want to see your feedback, good, bad, and ugly, because that's why we created the group, because we wanted to, one, keep you away from scams and convicts. Two, we wanted to give you information that helped us. The admins of the group, we don't exactly use the same strategies, but that's why it's important that, hey, this strategy works for me. This strategy works for Brian or whoever. If you're having a level of success, that's what the group is for. We want you to share. So it's not just me and Brian and Ryan running the group because we're so awesome. We created it so we can build up other people and have them share. Look at the tagline on the front of the page. Okay, you learn. And then you share. We want you to teach. We want you to give back. So I'm not saying my strategies are the best. They happen to work for me. More videos on spreads. I'd be happy to do that. Okay. Maybe I'll make kind of a smaller, just video series, not so much webinar. So yeah. But yeah, go ahead and try hedging in demo. Okay. Again, you would only incorporate that if you're wrong. So if you're right in demo all the time, awesome. But if you're wrong, be like, oh, maybe I'm going to hedge. What are you going to do? Are you going to hedge on the same instrument, but then you got a dead zone, or are you going to hedge using a different instrument that is moving the same way, or hedging using another instrument that is moving adversely, the opposite way? So I want to hear your feedback. If it's working for you, or if it's not working for you, then we can fine tune that maybe. But I need you to share with me in order to do that. Can you do a video about deviation levels? Jamal, are you talking about specifically using them in your trade plan? Yes. Sure. I mean, that should be a quick one. I mean, it's basically just respecting those levels and understanding the percentages. So I'll briefly explain it. So think about, so if the market goes up and down, on average 90 points, let's say we took a year's worth of data and the average from high to low was 90-point range. But you do have days that it broke 200, 250, 300. Okay? So what percentage of throughout the whole year did it exceed that range? So that's what deviation levels are. Deviation levels are expected ranges for that day. The way I come up with those levels is I use historical data, 1 year's worth, to map those levels out. So basically, price or the market will close within a half deviation, whether it's minus 0.5 or plus 0.5. There is roughly a 35% chance that the market will close within that range. When you're talking plus or minus 1 or a full standard deviation away from price, so wherever price settled the day before, if it moved a full standard deviation, whether it's down or up, there is a 68% chance that the market will close inside those lines. Okay? Now let's take it out to a deviation and a half. There's roughly an 84% chance that price will close within those two lines, a deviation and a half either way from where price settled yesterday. Then when you get up to a 2 deviation move, a 2 standard deviation move, that's a 95% chance that if you sold above plus 2 and you bought below minus 2, you have a 95% chance that price is going to close inside those lines. And then when we talk about a plus or minus 3 deviation, there's a 99% chance the market will close inside those lines. So does that hopefully give you a little bit of clarity on why we use it? We're just using it for probability, right? There's that 6, and when it touches a plus or minus 1, you shouldn't say, okay, this has a 68% chance. Look what happened today. Let me clear these. I know Brian got into a trade kind of using probability in his favor. So let's look at that trade. These pivot points drive me mad. Yeah, let me kill those. All right, so here's the plus 1, this yellow line here, tan, whatever. And then price at the end of the day was just hovering right at plus 1. 68% chance that this thing was going to finish under it. Where did it go? At about... Oh, actually, let me see. I don't know if it finished under it. So 16, it did. Yep. These two candles, this candle right here closed just under it, but 68% chance. So we look for those, but you got to be careful because obviously it takes a lot of volatility to get up to those plus and minus 1 deviations. So you see it, we went right past plus 1. So even Brian and I were talking, we were like, ooh, this could go to 1.5, could go to 2, blah, blah, blah. We're just thinking about probabilities. But it came back down. And I think Brian got in the 660, and that finished more than safe by the end of the day. There's a 620? I thought you said, oh, anyway. but that is how you use deviations. And adversely, so let's say we got into a trade late, like a big trend trade like we had today. So here's another examples of how you'd use deviations. Okay, so with this big run up, say you got in the game late. Okay, so you bought, you're like, you know what, I'm just going to scalp. I don't think it's going to close under or above this line. So you got in late. Okay, well, what do you know? What do you think? Or once it reaches deviation, you got to start respecting that level. So what would I do when price gets up here? Yep, good job, Trina. I would take profit because I got to respect that line. Now, obviously, you know, I'm going to use my trade criteria to see if the market is exhausted. You know, it exhausted a little bit up here, so that'd give me a little more profit because it's a little higher than +1. But same rule applies. So we use these levels to look for reversal trades, and then we also use these levels if we're already in positions that we're going to use them to take profit. All right, guys. Well, unless you guys have any more questions, I think we're going to wrap it up for the evening. Anybody else? Excellent. Well, guys, I really appreciate you joining me tonight. It was a topic I was very excited about. It's really helped me in my trading, and it really kind of helps you slow your mind down and put a plan in place and not freak out just because you see a red number. Okay, there's always a way to find profit. You just have to use math and kind of just stay calm and get paid. Happy to hear it, Trina. I hope it works out. Just please give us feedback. Preferably just post it on the Facebook page because I think a lot more people see that than they do in chat. So and that way we can all comment on it. And you know, if you're having trouble or we want to celebrate your successes, we want to make sure that we're all there for you. So, all right, guys. Well, you have a great evening, and we'll see you tomorrow in the markets. Take care, guys.